In this video, I'm going to be going over exactly what mortgage default insurance is and how much it's going to cost you if you choose to put less than 20% down for a down payment. Welcome back, guys. It's Tom here from Off of Mortgages. Today I want to clarify the topic of mortgage insurance, as I see a lot of people out there a little confused as to how it works. Mortgage insurance is a mandatory insurance in place for properties that have less than a 20% down payment. It's also most commonly referred to as CMHC, but it's important to note that CMHC is just one of the insurers out of the three. The other two are Sagen and Canada Guaranty. Mortgage insurance comes into place whenever the loan to value exceeds 80%. The reason why it's in place is because lenders require that it's there in case you ever default on your mortgage. Let's put ourselves into the shoes of the lender and say you're borrowing money to the borrower and they end up defaulting on their mortgage. You want to make sure that that money that you loan them gets back to you. So in the case of a borrower defaulting on their mortgage, the lender then has to sell that house in order to regain that money. So ultimately, if there's less of a down payment on that house, there's more of a risk for the lender to not get the money back when they go to sell the house. The lender ultimately feels more comfortable having that insurance in place if the borrower were to ever go into default. So before we get into the costs for you as a borrower, please like the video down below and hit subscribe. That way we can grow the channel together and more people like you can see these videos. So how much does it cost you as a borrower? So let's use an example of a $500,000 purchase price. So as you can see, we have a 5, 10, and 15% down payment option. So if we're looking at the 5%, you'll notice that the insurance premium rate is higher versus going all the way over to the 15%, it actually lowers. So what that means for you is the total cost of the premium starts at $19,000 with the 5%, and it goes down to $11,900. Again, this is for a purchase price of $500,000. And also you have the PST insurance. This is for Ontario. It also lowers as you go down to the 15%. So one thing to keep in mind is the total cost of premium. That's actually going to be added on to your mortgage. So it's not required to be paid up front. However, the PST insurance, the tax, is required to be paid up front at the lawyer's office when it comes time to signing. So let's dive into the pros and cons of mortgage insurance. The first pro of using mortgage insurance means that you're going to be getting into the market a lot sooner rather than waiting for a 20% down payment. The second pro, believe it or not, as a high ratio mortgage, you actually have access to the lowest rates. Now diving into some of the cons, the obvious one is that you're going to be paying quite a bit upfront for that mortgage insurance premium. So the second con that most people don't realize is when it comes time to submitting your application and getting approved, the lender has to approve your file as well as the insurer. So this obviously makes things a little more difficult when it comes time to getting approved because you have both the insurer and the lender looking at your file and they both have to agree on it. Every lender and insurer has their own policies, so what you might get approved with the lender, the insurer might not agree on. However, with that being said, if you only have 5, 10, or 15% for a down payment, don't let this be the reason why it should shy you away from it. So should you go with mortgage insurance? My personal opinion is if it's going to take you a long time to save up that 20% down payment, then you definitely should get into the market as soon as you can and pay that premium. Now, some people may disagree with this, but my logic behind it is if you can't get that 20% down payment relatively soon, then you're going to be missing out on that market appreciation. I've covered this in previous videos. However, I'll just go over this very briefly. If you're missing out on that market appreciation, it's essentially going to hurt you in the end because saving up for a 20% down payment is definitely going to take you a lot longer than how much you would have made on that market appreciation. The initial mortgage insurance premium that you pay is definitely a decent amount. However, the market appreciation definitely outweighs the cost of the mortgage insurance premium. At the end of the day, it all depends on your current situation, so I'll leave it at that. So that's it for today's video. I hope you guys enjoyed it. I hope that also gave you clarity on exactly what mortgage insurance is and whether you should or shouldn't go that route. Thanks again for watching, and I'll see you guys on the next one.